Hello, I'm Mike Graham. I'm the president of Midwestern Securities and the host of the Banking on Growth podcast. With us today, we have our friend Jim Perry. Jim, welcome back.
Thanks, Mike. It's a pleasure to be with you again.
Oh, it's great to be with you too. I know we were talking a little bit before we started recording, and we just got to start recording. There's some great things to get through and discuss today. And thanks again for being a return guest on our podcast. For our listeners who haven't heard you before, our listenership has been growing, thankfully, and we're getting a bigger audience out there. But for those who aren't familiar with you and your organization, will you introduce yourselves to them, please?
Sure, absolutely. Again, Jim Perry. I'm a senior strategist at Market Insights. We're a consulting firm based out of Seattle, Washington. And actually, I am based out of the Midwest. Makes it a lot easier for me to travel around the country. But we've been working for about 30 plus years to help community-based financial institutions understand their market data, their customer data, so they can make better choices and better strategic decisions about how to grow.
Excellent. And you are plugged in, you're a student of the industry, you are sharp and a great conversationalist. So this is going to be some great time to spend together here. I'm excited about it. So we want to talk about the Genius Act primarily and the future of banking with stablecoins. I feel like I'm a student of this area and I still don't have the understanding that I need to, but in comparison to a lot of other financial advisors, bank presidents, I feel like even with my limited understanding of this and all of my questions that go through my mind, well, how would this impact this? Or what does that mean for this types of questions? I feel like I'm not even scratching the surface yet. And I read about this. I seek out podcasts. I seek out literature. I try to get in the room with smart people like you, and I still don't feel like I have a great understanding of this. So I really appreciate your time to educate me and our audience more about these things.
Well, the one thing I will tell you, Mike, is there's a lot to know, but there's a lot that's yet to be known. There's so much about this that is evolving, and there are a lot of moving pieces. If anyone tells you they're an expert on stablecoins, they're probably not telling you the entire truth. I just had a friend of mine post a story a couple of days ago, or comments about stablecoins, saying we're barely even talking about the intersection between stablecoins and AI. From the travels I've been doing over the last couple of weeks, especially I've been with Kansas bankers, I've been with Minnesota bankers, and every banker that I talk to these days, when you say the Genius Act, when you say stablecoins, when you say blockchain, there's still a bit of that deer in the headlights kind of gaze, because it does require kind of leaning in and digging deeper into not only what is actually occurring, when it's likely to have some impact on us, and when things are likely to change up even bigger. Suffice to say that I'm glad we're having this conversation today, because this is going to be game changing in payment space, especially as I've heard described, it's kind of changing the plumbing of banking.
Yeah, well, I'm looking forward to digging into this, changing the plumbing of banking, which I've been asking bankers, how does this work? And I get a lot of that. What do we need stablecoin for? We already have a digital dollar, right? We already in the form of ACH, and but let's dig into it. Can you give our audience an overview of the Genius Act and maybe an overview of definition of stablecoin?
Okay, let's see. Before I talk about the Genius Act, let me remind everybody it's been 15, 16 years or so when the term blockchain really started to rise up into our awareness or our consciousness, became kind of public conversation about how this could represent significant change in the financial services industry, because, of course, that blockchain technology would allow for the kind of exchange, the very rapid exchange between digital currencies across multiple platforms and multiple blockchains. So unlike ACH, which can take, several days sometimes to process between institutions, part of what happens through blockchain technology is it speeds up those remittances. So stablecoin essentially is a type of cryptocurrency. When you think about cryptocurrency, and a lot of bankers have shied away of really even knowing very much about cryptocurrency because of all the risk and perceived risk that's involved. But of course, stable coins are a type of cryptocurrency that's really designed to keep a steady value, because unlike Bitcoin, unlike Ethereum, which of course can swing wildly, as we've seen over the last 5 or 6 years, stable coins are pegged to something stable like the US dollar. I always like to explain it very simply. Try to imagine one stable coin equals $1. Tomorrow, next week, next month, it should be worth $1. They achieve that stability by keeping reserve of dollars, assets, or by using an algorithm to adjust the supply and demand. So it's that stability that actually makes it a good tool for digital payments, for remittances, and certainly even decentralized finance. Here's the catch. Not all stablecoins maintain that peg perfectly, especially under stress. And that's why regulators want to get involved. They wanted to see some kind of movement. Now, the Genius Act, which of course was passed earlier this summer, the thing that I've been telling audiences lately, banking audiences, is this law creates a federal framework for stablecoins, which is brilliant. There was a lot of involvement on the parts of major organizations like American Bankers, like ICBA, like many state banking associations, really trying to make sure that this legislation gave the industry what it needed to regulate and manage the stablecoin environment. The big shift here, though, isn't in the technology. It's about trust. Because what happens when you kind of sign legislation into law, what that does, it gives stablecoins a legitimacy in the eyes of consumers, in the eyes of regulators, in the eyes of businesses. That means stablecoins could all of a sudden become more attractive, especially if they're built into platforms that people already use. Before I kind of dive any deeper into this, does this help as a starting point?
It does. So let me back up a step. Blockchain technology, decentralized ledger technology versus centralized ledger technology. Most of the financial services industry works off of some form of centralized ledger technology. It's redundant servers from clearing firms in some capacity. You've said two things. You've said speed and you've said trust. And so I want to dig into speed first. So my understanding, when I started studying blockchain technology and decentralized ledger technology, I thought, well, this could be great. It could be a great equalizer for small broker dealers like Midwestern Securities that rely on the major clearing firms of the world to do things quicker, cheaper, easier with blockchain technology. And I dug into it excitedly, but then I became kind of, it's not going to work. It would be easier for multiple redundant major servers. And I'm not a tech guy, so I'm probably butchering some of this, but to create the speed, and to create redundancy for fact checking and accuracy that the blockchain is supposed to do with, lots of data, decentralized, held all over the place. And so although I dug into it, I thought, well, this could really change the securities clearing world. My conclusion initially was it won't, because we already have the ability to have redundancies for backups for verifying accurate data.
Mm-hmm.
And we can do it as quickly as we want if we change practices. Maybe that's a key phrase here, if we change practices. And centralized ledger technology burns less electricity than potentially, decentralized ledger technology. So I'll just pause there. Any thoughts on that, Jim? My enthusiasm originally to maybe we're better just with the system we are, with some tweaks to it, versus blockchain for things like clearing.
Well, I will simply say this. From those early days of blockchain conversations, obviously, we've seen that technology evolve rather exponentially. And part of that has to do with how all technology has been evolving. I think I always tend to look at what has motivated either the financial services industry, securities industry, even retail industries from being interested in blockchain, from being interested in this in stablecoin, certainly, and ultimately, whether it's global payments and being able to easily send payments around the world, or if it's to make things simpler and easier for a consumer to transact. I can see that there are a lot of different motivators moving a lot of different folks forward on this. Again, I'm not the tech guy either. I'm a strategist. So I know enough about basic blockchain technology to know that it's actually been capable now of managing this stable coin for quite some time. Even I'm sure you're aware, it was PayPal a couple of years ago issued their first stable coin. And all of a sudden what is it? How many? They have 700 million users around the globe. They all had access to PayPal stablecoin. And again, what makes them stable, I'll remind everybody, is simply that it has to be pegged to an asset, like the dollar, to make sure that we're not going to see these wide fluctuations. There's definitely some downside to the industry, and we can dive into that a little bit more. But I don't know if I answered your question very well.
Well, it's an ongoing discussion, and it's good. I think you answered it perfectly. And we're all trying to figure it out. The speed piece is, if the current centralized approach could be modified to make international money movements easier, it might already be there. That blockchain's trying to do. They're both trying to do the same thing. There could be changes on the centralized portion that would make it more competitive than the decentralized blockchain. But sometimes you need this disruptive technology to motivate the existing players to drop their fees and make it easier and make it quicker to do the things. And it's certainly a disruptive technology. And part of me wonders if that's why Trump likes it so much, because it's disruptive, and it makes people uncomfortable and forces them to think differently about this, or change behavior to be moving forward, perhaps. But the speed piece we talked through a little bit. The trust piece, though, tell me, the trust piece, are you referring to consumers will trust it more now that it's being regulated more? Okay. I've also heard the other piece of the trust piece from bankers saying clients are interested in a PayPal or a potential Walmart stablecoin because Gen Z might have a higher trust with those entities than they do the US government, which is odd because behind it is a dollar or a treasury or an equivalent, which
Right.
is backed by the government's ability to raise our taxes. You know?
Well, part of it, it's interesting because that you mentioned Gen Z, because let's go down the Walmart route for a moment, because one of the things that the Genius Act currently in its current iteration, and I think I'm going to put a pin in that comment because it's important to talk about how there's an effort underway currently to go back in and close some loopholes that are in the current legislation that need to be fixed. But before I do that, let me simply explain. The Genius Act, as it's been passed into law, potentially has the room for somebody like Amazon or Target or Walmart to eventually issue their own coin. So imagine Walmart coin as an example. For them, obviously, it's a huge potential money saver for them, because if they issue their Walmart coin, what's going to happen? Consumers will take money out of their banking accounts to buy these coins, and you know full well that Walmart will incentivize them to use their coins for in-store purchases. By doing so, every time somebody uses a Walmart coin to pay for their purchase, Walmart's going to save on those interchange fees that they would normally have to pay out to any kind of card network or any bank. So potentially, this represents a huge savings for an entity like Walmart. It's estimated, they could save annually over $800 million. That was the latest projection I saw, but it's probably greater than that.
So with the Walmart, I see the savings on the interchange fees. Could Walmart tie the purchases though to discounts at Walmart, or would that be illegal with the Genius Act to say you get a discount on your groceries if you use? And I know we're getting theoretically if this, if that, but could they do? Where would that be part of the anti-tying?
Well, as far as I understand, the only kind of significant restriction that was placed on stablecoin issuers is that they cannot offer any interest on those coins once they're held. So obviously that takes away some of the incentive for someone to say, I'm going to keep $500 in Walmart coin. So next time I go to the store, I can make an easy purchase that way. But I don't believe there's anything in the current law that would prohibit Walmart from saying, today we're giving 10% off to people who use their Walmart coin, or here's a Walmart coin. And if that's the case, of course, imagine the same kind of scenario with Amazon or anywhere else. I mean, when I look, I think there are probably 170, 180 Walmarts in Illinois, as an example. Just the Illinois stores alone, if they were deploying a stable coin in that way, that could represent significant savings to the company. So one of the problems with the law was that there was that loophole that I mentioned a few minutes ago, which says, okay, any issuer of stablecoin can't pay interest, but it doesn't stop exchanges or affiliates from doing it indirectly. So there's a loophole that banks are already asking for Congress to close. And so in this next legislative session this fall, I expect fully that there'll be a major effort to revise the Genius Act to close that, because otherwise, some of the protections that were intended by the law, there would be a workaround for those who wanted to try to do it. Now, all that being said, as I mentioned to you, I had the privilege of spending a little bit of time with Mickey Bowman at the Kansas Bankers. And of course, she, there was just a lot of excitement over all that had happened with her elevation at the Fed now. And, but there's a lot of concern about how stablecoins could potentially or could eventually impact community banks. Before the law was passed, the Treasury was actually estimating that upwards of $6.5 trillion could flow out of banks with stablecoin passage. So at least now the regulatory environment is going to make it very difficult and set up very specific paths to even be able to issue those coins. They've put up a lot of barriers that folks are going to have to think very carefully through in order to get this. And at this point, the regulations or the actual rules promulgated from that law probably won't be done until late 2026, which means the provisions of the law won't really even go into effect until 2027.
Jim, do you know what percent of community bank deposits 6.5 trillion is?
Not off the top of my head.
So that'd be an interesting data point to understand as a percent what that impact would be.
But you were talking before, again, to the issue of trust. And when you stop and consider the fact that, especially amongst our youngest customers and youngest consumers, our Gen Z and Gen A that's coming after them, they're already kind of living and functioning in that place of Venmo and PayPal and
Right.
digital exchange of funds. When you look at how these digital currencies could be exchanged through gaming, as an example, it begins to blow the mind, I'm afraid to say, in terms of the implications for deposit runoff, especially for smaller community banks that rely on those deposits and are working so hard to gain deposits these days.
Right. Let me back us up one step. I just want to do this for a second because then I want to go right forward into what you're just introducing is the deposits and how this changes the plumbing. So Walmart, potentially in this scenario, Walmart monetizes this by saving 3% on interchange fees. And then potentially, if they've got a dollar for dollar in the treasury, maybe they're getting a couple of points on that too. Is that right? So maybe they're getting, I don't know the length of the treasury that they're able to hold, but say, 3.5 or 4% even, plus they're saving 3% on interchange fees.
On interchange fees.
When Walmart monetizes this really well, then they've got the captive dollars. I get how they benefit from it. Maybe the consumer ends up with a cool gift card on steroids that has discounts tied to it potentially. Tanks, you're helping paint the picture of the why.
Before you go on, let me also add to that Walmart would essentially gain greater control over that kind of customer payment data as well, because then control more of that data. So the more they know about the consumer preferences, it allows them to, again, continue to refine their own efforts to gain more of that digital wallet.
Right. And so they have the data, then they market more precisely to the customer and drive more sales. And gotcha. So there's huge financial motivations to the Amazons and the Walmarts of the world to do this. So they're coming. And then those dollars, and the Gen Z, Gen A, as you referred to, are comfortable with this stuff anyway. I've got two boys, and they're our youngest just graduated from high school, and he knows that if he's mowing the grass or doing something around the house and I owe him some money, he sends me an Apple Pay request, and that gets paid within 5 minutes versus me waiting or him waiting for me to have cash in my wallet.
Right.
So we're very comfortable with that.
There's that speed you talked about.
Right, exactly. Yeah. They trust it, they're comfortable with it. So if they're doing the business that way, it's not going to community banks. It changes the community bank plumbing. The community banks don't have the deposits. The community banks don't make the loans.
Right.
And if the community banks don't make the loans, they don't make the spread. They don't have a return for their shareholders. They sell, they go away. And then where do the small businesses and the homeowners get funded?
Great questions. And these are precisely the things that now, I think, as we may have talked before, you see a growing divide within the industry amongst the massive players like the Chase and the Bank of America, who have been, of course, working on the development of their own stablecoin for quite some time, just like Walmart and Amazon, who have been, they've got some of the back end rails, so to speak, already underway. They're exploring, they're iterating, they're trying to imagine, in anticipation of this law, how they could make that happen for themselves. But when you've got these massive players doing that, despite the best efforts of community financial institution champions that are trying to make sure this doesn't kind of kill them off, that it's the David Goliath kind of who's going to win here. We don't know how this is going to play out yet. We can anticipate and try to project and make sure community banks are thinking ahead and making sure they continue to add value, so that they present a clear choice to any younger consumer, but honestly, it's the reason it's making a lot of community-based institutions really nervous about the potential here is because they're not ready to compete completely in that digital realm, in that digital payment space. I mean, I look at the number of financial institutions that still haven't participated in FedNow as a way to, again, speed up those real-time payments to actually put them in a greater competitive space. And also, I mean, even to play that role of educating the consumer about the kind of relative value of working with a Walmart coin as opposed to working with a local community-based institution.
Yeah. I think our minds immediately go to some sort of straight line projection to worst case scenario. And it's likely, it's rarely that, right? Most of the time there's adjustments here and there. How do we add more value, as you said, with education? How do we be more advice driven partners with our clients instead of a transactional commoditized order taking relationship?
Mm-hmm.
How can we add more value to those ideal customers that have multiple complex financial needs that non-interest income sources like investments, wealth management, trust, accounting, insurance could do, could bring more customers in that want more of that relationship and can generate non-interest income for the institution that could make up for a loss or decrease in interest income if funding dropped or was reduced. So there's a lot of between here and there.
Well, absolutely. And I think the thing to keep in mind is that the implementation of all of this is going to be multi-year, and it's going to be very complex, and there's going to be a lot of things to pay attention to. I mean, the impact here, of course, at the end of the day is going to depend entirely on the adoption by consumers. It's like right now, unfortunately, I haven't seen any detail in terms of the volume that PayPal has experienced since they issued their own stablecoin. I don't believe they're required to report on that yet. Of course, what will happen through the regulation of the Genius Act is that any stablecoin issuer will have to report back to Congress on progress and enforcement actions and all the rest. So, or the regulators will have to continually report back to Congress. So there will be more guardrails. There will be more things, as I mentioned earlier, more kind of hurdles, I guess, not barriers, but hurdles, things that people will have to jump over to even get to a point where they can actually issue their own stablecoin. But make no mistake, it is definitely kind of game changing. It's shifting the way we think about so much in financial services. And that's why, as I say, I really loved Bradley Lemer's kind of notion that here through like AI, we're commoditizing intelligence, right? And through stablecoins, we're tokenizing value, right? All of a sudden, those two things are going to continue to accelerate. And I mean, look at how AI has morphed in the last 2 years, as an example. I think what we're trying to do is regulate the genie now that it's out of the bottle relative to stablecoins.
The genie out of the bottle. I remember being in a community bank boardroom a dozen years ago, and one of the board members was probably 80 and had a son or a grandchild telling him about crypto and that he was putting his money that would have been in the bank in crypto at that point. And I remember thinking to myself, I wonder if he sees where this is going and if he sees that this is disrupting his own business venture. His behavior is disrupting his own business venture. It is a competitor to the American banking system. And yet so many are dancing. I hate to say this because I don't want to be anti-tech, but dancing with the devil in this, that they are, if a bank board member or leadership is conducting business in stablecoin or in crypto, it is a competitor to their business venture. And I guess they figure you have to play it and navigate it and add value, like you said, to make sure that it doesn't kill you.
Well, one of the things that, you've been in the industry long enough, and as have I, to know that, as an example, using Walmart so much in this conversation, bankers have been worried about Walmart finding ways to disintermediate their business for a long time. And now this just kind of continues that conversation. I think ultimately for financial institutions, the impact of stablecoins, it does come down to this notion of greater competition not with banks, but with tech platforms and retailers and payment providers that consumers have become increasingly comfortable with. And that is kind of the post-pandemic reality that we find ourselves in now. And that happens to be much truer for the youngest among us. So there's a lot to know, but it puts pressure on institutions to innovate. These transactions are fast and they're seamless, and banks are going to have to modernize their own rails in order to keep up.
Yes, pressure to innovate. As you're talking about, Walmart's bank was Wood Forest, is that right?
Yeah.
And the changing landscape and disintermediation in that last 25 years, there's probably 4,500 charters that aren't there anymore. And those are the ones who weren't willing to invest or didn't have the whatever resource, right? And it's okay. Not everybody has those resources. Sometimes the best thing is to sell or merge or look for somebody who can bring complementary resources that allow you to serve your customers better. But the charters didn't go from 8,500 or 9,000 charters to 13,000 charters, right? It's not easy. It takes that foot on the pedal type of innovation and to create a sense of urgency inside of your institution to grow and thrive here.
Absolutely.
There's opportunities, and we've talked about some of those, but it takes that intentionality.
It really does. And I'm suggesting, whether it's around your boardroom table or around your staff table, you need to be having these conversations, because my purpose is never to put doom and gloom or to scare people. It's simply to say, pay attention to what's going on in the broader ecosystem of financial services these days, because it's already impacting you and the impact is going to grow. Keep paying attention, keep finding new ways. Talk to your customers. Make sure that you continue to align yourself with what they value. And if you cannot, we've already seen all kinds of data that point to, we're not doing a very good job as community banks of securing some of the youngest customers. We're just not. I think Cornerstone Advisors, their annual data said 4% of new checking accounts went to community banks in 2024. It's awfully small. 44% went to digital-only banks and fintechs. So we're losing even the place to be part of the conversation, because we've been kind of stuck in old business models. So we need to keep showing that we can be adaptable to this digital age.
That is a powerful summary, I think, of our discussion, Jim. We've had a really good brief discussion, and I'd love to revisit this in a few months. What have we both learned? What questions have come up that we didn't anticipate? And I'm sure in 6 to 12 months, people are going to be listening to this and be like, why didn't those guys understand that at that point? I have this saying, peak intellectual capital. We always got to keep learning and keep growing, because
always
the world's moving by. We have to stay up. We have to keep up. Are there any kind of parting comments to our listeners that you'd like them to be aware of around the Genius Act or stablecoin before we wrap up today?
Well, I would simply invite them to stay engaged with this topic. Make sure you're asking questions about it, because there are, your state associations, you've got a lot of people that are paying a lot of attention to the minute details of it. Follow how this law evolves, and think about how your institution's going to maintain trust and relevance in a world that can move at the speed of light.
Great. trust and relevance in a world that can move at the speed of light. That summarizes a lot of what we covered. Jim, for our listeners, what's the best way for them to follow you or learn more about you and your business?
Probably the easiest way is to go to our website, formarketinsights.com. That's FOR, marketinsights.com. My contact information is there. It'll give you a link to connect with me on LinkedIn.
Jim, you are a professional and a very knowledgeable guy who's very easy to talk with. So thank you for joining us again. And I hope we can do this again before too long.
My pleasure, Mike. Anytime.
Thank you. So on behalf of all of us at Midwestern Securities and Banking on Growth, to our listeners, thank you for joining us. We hope you found this very valuable. I know I certainly enjoyed it and learned a lot from my friend Jim Perry. Thank you.
This has been another insightful journey with Banking on Growth with Michael Graham and Midwestern Securities, a member of FINRA and SIPC. We appreciate your time. If you found value in today's discussion, consider subscribing for more thought-provoking discussions in the world of finance. Your support helps us continue to bring you quality insights. If you have a topic you'd like us to consider covering or have thoughts on one of our episodes, we'd love to hear it. Just email us at media@midwesternsecurities.com. Remember, the power to grow is within you. Thank you for being a part of the Midwestern Securities community. Until next time, stay inspired and keep banking on growth.